This is Made for More Living with Johnny Jennings, powered by eXp Realty. Online at madeformoreliving.com.
We're back with JJ Mack with American Pacific Mortgage, and we are talking about saving up for a down payment. Dave Ramsey says you should save up 20% to avoid mortgage insurance.
That's what I did.
That's what you did?
That's right. Because I followed Dave Ramsey because he knows what he's talking about,
He
right?
does.
No? You don't agree? You don't agree with the Dave Ramsey?
Well, here's okay.
Dave Ramsey is like a god when it comes to financial savings and getting out of debt. Don't you agree?
Well, he is.
He's got his own radio show that's
true.
syndicated. I think it is. I think what it is, you're just jealous of his.
If you have your own radio show, you should. There's everything you say is truth.
Right.
Everything you say is truth. So, so here's my thing with Dave Ramsey. Here's two things actually with Dave Ramsey. One, this is a business. This is, at the end of the day, this is a business, and businesses do not exist if they don't make money. Even nonprofits don't exist if they don't generate revenue.
Sure.
And so when you're listening to somebody, you got to figure out, okay, what's the angle? Why are they saying that? What's the stand? What are they benefiting from? How are they profiting from this message? And when it comes to Dave Ramsey and say real estate agents, like I used to be what did they call them back then? An endorsed local provider. I used to be an ELP. Valerie and I waited years. A spot opened up. We finally got it. And then 3 months after signing up, it was taken away. And you know why it was taken away? Because we were with eXp Realty. And we still are currently as of this recording, because we were with eXp Realty. Even though our ranking was high, even though our customer satisfaction was high, even though we had done nothing wrong, all eXp agents nationally lost their ELP endorsement because Dave Ramsey said, no longer are we going to allow agents to be on here. They even told
Why?
We don't know. They never came out with an answer. But they said, hey, as soon as you leave eXp, reapply, we'll be happy to take you back.
Wow.
So it was not performance-based. It wasn't merit-based. It was because of the company we were with. And so when I hear Dave Ramsey giving financial advice and saying, hey, you should do certain things, I'm wondering, okay, what does he have to stand from it? Because he's clearly not caring about who is the best qualified person in the marketplace. That's not who he cares about. There are certain standards behind the curtain that that's not made aware to everybody. And so, again, he says a lot of great things. He helped Valerie and I get debt free. Like, I totally respect what he's trying to accomplish, but you got to look at it through like that filter.
Okay, so let's go back to the 20% down payment.
So
why are you saying
down
that's
payment,
not ideal?
Well, let's say, how long is it going to take for you to say? So let's say the average price somewhere around, let's just say $550,000. 20% of that is, you're the lender. What's the math on that one?
Well, $500,000, 10% is $50,000. So now you're $120,000, $115,000.
How long is it going to take somebody to save up $115,000? Like that's typically like one income. Several years at least, right? And then compare that to what's the normal appreciation rate. Somewhere in our market, it's been as high as, well, it's been really high, but let's just say 3% a year. It's really dialing this number back. We're talking about a lot of numbers, so hang in with me. So how long would it take you to save up 110 versus that same house? Let's say you bought it today for $550. 3% is $15,000. Right. Another 15. So 3 years, that's $45,000. So you, in your financial wisdom, decided to take years and years and years and years to save up. Let's say it took 3 years to save up $110,000, so you can save some money on mortgage insurance. Because that's his whole reason why you want to save the 20%.
Right.
So you don't have to pay the mortgage insurance. JJ, what's the typical mortgage insurance you're seeing? Like, let's say it was a $550,000.
So let's just say you had, 740 credit score and you put 3% down.
Mm-hmm.
Your mortgage insurance is only going to be roughly around $300 a month. Now, if you put 10% down, it's probably going to be like $100 a month. And it could be a lot less than that if you even have a better credit score. It could be as low as $50 a month. So you're looking anywhere between $40 to $300 a month.
So let's take worst case scenario, $300 bucks. That's $3,600 a year. That's, what is that? 36, 6, 9. So what's that? About 11 grand over the course of those 3 years. That's how much that mortgage insurance is going to cost you. Mm-hmm. Whereas if you had just bought the home, you would have made basically, what is it?
Whatever the appreciation.
$45,000, $60,000. So you lost $50,000 to save $11,000. That's how the math works out in an appreciating market. Are you tracking?
Yeah. But it's not like that money just went away. That went into your home, that down payment.
Yeah, the down payment did go into the home, but you lost that. You missed out if it took you 3 years to save up $110,000, you missed out on 3 years of appreciation if you already had the smaller down payment sitting in the bank.
Right.
So you missed out on all that money just to save $11,000. You lost out on $50,000.
Interesting.
So that's why maybe it's not always the best to save up for that 20%. And let's say that happened, like you like say you had the down payment a couple years ago, and now is year 3. Well, shoot, now you don't have 3 and 4% interest rates. Now you have 6-7% interest rates, and you missed out on the appreciation. So now you have a higher monthly, even though you don't have your mortgage insurance, you still have the higher monthly. Now, so that's why it's like, you just got to be careful with.
If you have a different perspective, text Johnny 530 get more 530 get more.
Yeah.
So and we're gonna get Dave Ramsey on the show, and you two are gonna go at it.
Oh my gosh. Yeah. My first question.
I mean, you make great points. I mean, I get it. That's a very interesting perspective. But he's been so passionate about this. For years and decades.
So what he does, he looks at it through a worst case scenario.
Sure.
He is very financially conservative.
He just sees so many people getting into debt and it ruining their lives that he's trying to protect them from, those situations. So,
but it's almost like, so 50% of marriages end in divorce, right? If you're down in apparently in Newport, it's upwards of 70% of marriages end in divorce. So
really?
So
I was just there.
So don't
Maybe
go there.
We shouldn't visit there anymore.
Oh my gosh, you got to find a different place to go.
70% in Newport? Seriously?
Yeah.
Oh my god.
It's a nice place. Why are they leaving? That's a great place.
We enjoyed it.
Well,
there's a lot of temptation down there too.
Yeah, I guess so.
So let's just use the 50% number. 1 and 2 end in divorce. Does that mean your daughter should not get married?
Right. Okay. So.
Yeah.
So what are you saying?
So my point is that if you're a divorce attorney, the divorce attorney is probably going to tell you, hey, you shouldn't get married. Make sure you have a prenup. Do all this stuff. You're looking at it through that lens.
Good point. Yeah.
If you're Dave Ramsey and all you hear all day is about financial hardships, you're going to craft a custom message that's very conservative.
That's a good point. Yeah.
So, well, and let's just like a good analogy. Let's just say, there's this microphone here, and I'm going to sell you this microphone for $100 today, but I know in 5 years from now, and in this microphone today, you're going to have to pay a little bit extra every single month to keep it. But 5 years from now, you're going to have to buy this microphone for $150 because it's gone up in value. So would you rather pay a little bit extra today to be able to save some money later on?
And invest
that in something else? It really does make sense when you look at it.
Yeah.
Every single time.
And I think you two are very smart guys. And so that makes sense to you. Right. No, but that makes sense to you. But for the layperson, that's just not. I mean, I think if someone was to take that advice, I think you'd have to walk them through of what, like you've been doing right now, walk them through that of how that makes sense and what you have to do to make it beneficial. Because you guys, obviously, you've gone through a lot of education and you do this every day. For the regular mom and dad or person out there, especially Gen Zers, they're not thinking like that. They're not thinking that
They're
straight.
not thinking at all.
Yeah, exactly.
They're still trying to figure that out.
That snowflake generation.
Oh, the millennials. The millennials are getting old. But so what's really cool is that we actually have a tool. So for lack of a better term, we'll call it a simulator, where it's how much money would I potentially make in appreciation if I bought now versus waiting? How much money would I save if I bought now versus waiting? What's the market going to do long term in the next 5, 10, 15 years?
It's true.
And so we have this special tool where we can actually plug in your specific situation and show you on a chart, hey, here's what's going to happen. And so it provides you with the certainty, provides you with clarity. It's not just us throwing numbers at you. It's a written report. And so if you want to get that report, if you want to learn, plug in your specific situation, it does not cost anything. Just reach out to us, 530-GET-MORE, 530-GET-MORE, and we'll connect you and get that tool over to you. And we'll actually show you how to use it. We'll walk you through it. So that way you can run through scenarios like, hey, if I wait to buy, what is that going to look like? If I want to buy an investment property, what does that scenario look like? There are some other ones too, like your 3-2-1 buy down program, right, JJ?
Yeah, absolutely. And the one that you were just talking about, the wait to buy, what we can do is we can actually put interest rates are a lot lower today, but we can even put an 8% interest rate in there. Let's just say you don't have very good credit. You could say, is this worth it for me to buy today at a higher interest rate or wait? And we will be able to show you exactly what that would look like. So that's really cool. But the 3-2-1 buy down, we do have this program as well. It's really cool. And we have this feature that we can send you, just like Johnny was saying. And in that 3-2-1 buy down will pay. So let's just say you do have a 7% rate that we're going to be offering you today when you buy that house.
Which they are starting to come down a little bit.
Yeah, they are.
Is that going to keep happening, or what do you think is going to happen there?
I think so. I mean, there was some really good news over this past 3 weeks that has happened. We've got some inflation data and unemployment data, all the fun stuff, right? We all want to talk about.
Yeah.
But
riveting.
Yes. But I'll just leave it at this. It's all looking better for interest rates. Now, they're probably only going to cut once this year, and we were hoping for twice over the last couple of weeks. But that's okay. We're still thinking that inflation is coming down.
So the good news is inflation is coming down. So if you buy the loan, and let's say you do this 3-2-1 program, how would that benefit them in the next couple of years?
Yeah, so let's just say you buy this house today and it's a 7% rate, or even now we're actually looking at rates in the 6s again. So let's just say 6.75. So a 3-2-1 buy down, what that does is it allows you to get a 3% less interest rate for your first year. So if you had a 3.75%, would you buy today? I think so. I would.
Absolutely.
Yeah.
We tell that all the time to our clients. They're like, I'm waiting for interest rates to come down. Well, what are you looking for? Well, I'm looking for a 5. Okay, what if I could get you a rate in the 3s? Would that interest you? Absolutely. So, but that 3 isn't there forever. That right? The 3%.
Right. It's just a rate for that first year to get you in there, and obviously we don't know when rates are going to come down, so we want to make sure the buyer is still okay with the higher interest rate if they do start coming up.
Yep.
Because that rate's only good for the first year, and then the second year goes to 4.75. Third year, 5.75, and then that's 6.75.
So hopefully within that 3-year period, you can refinance to a permanently lower rate.
That's the hope, yes.
Yep.
But we just still want to make sure they're qualified and they're good to go, even if it doesn't. But I would bet, if I was a betting man, I'd probably bet on rates to come down before then.
But even 2 years, what did you say the second year is?
4.75.
So even that,
so you're saving
appealing to a lot of people right now.
Absolutely. So you're saving 3% the first year, 2% the second year, 1% the third.
And you've got 2 years, and the way things are trending, you've got a lot of options in those 2 years.
There's a lot of life that can happen. Like think about what you were doing 3 years ago.
Right.
Like it's totally different today, right? There might be some similarities, but what were gas prices, what were food prices, what were interest rates? A lot can change in 3 years. Like we were just coming out of COVID 3 years ago.
Right.
Right. And so as far as what's really great about this program as well is with your company, JJ, not all companies provide this. You're actually you get a free refinance.
Yeah, we do. And we feel really strongly, like I said, about helping our people out and who've worked with us. And so we're not going to charge you again. We want to get you into a home now. We want to help you start building equity. So we're going to pay for those underwriting fees and those costs that we would usually charge when you refinance.
Perfect. So let's use that example again. Let's say you use the CalHalfa program. Or how does that work? What programs can you marry with this 3-2-1?
Yeah, actually you can. So you can do that. So CalHalfa, you can do FHA, you can do the VA, you pretty much do anything.
Okay.
There are some jumbo loans that can't, but most loans you will be able to do a 2-1 or a 3-2-1 buy down with.
So let's say you're a first-time home buyer.
Yep.
You're using the CalHalfa down payment assistance program. So it's 0% down.
Mm-hmm.
Now you're getting a 3% interest rate that's a lower interest rate than what the market is currently at.
Yep.
So now you're in it for basically no money. And over those next 3 years, let's say use the example that we gave, $500,000 purchase price. Over the next 3 years, you're going to make at least an additional $45,000 in appreciation alone.
Super cool.
Right? And you're getting in with very little money down. So that's why, JJ, you guys work with luxury buyers, but you also do a phenomenal job with first-time home buyers. Yeah,
that's where we started with, back in 2009 when I got into the industry, and it was a great time. And I will say one thing about the 3-2-1 buy down that I love is you get a huge tax benefit from it. I was talking to some of my past clients that we just did loans for a couple of years ago. They're taking these 7 or 7.5% interest rates last year, and they're still being charged the 7 and the 7.5% interest. It's just they've accumulated enough money in this reserve account to pay for that extra interest over the next 3 years. when that loan closes.
Yeah.
So what you're able to do at the end of the year, you're still able to take the full advantage of all that interest and save a ton of money at the end of the year.
Oh, wow. That's a bonus.
Huge.
Awesome. Well, hey, if you want to learn more about the 3-2-1 buy down, if you want to get the calculator, if you want to just be better prepared, it's never too early to pre-plan. We've never had somebody come to us and say, hey, I wish I would have started this sooner. But we hear almost daily, man, I wish I would have started. I waited too long.
Amen.
I wish I would have bought. So just reach out to us. You can call or text 530-GET-MORE, 530-GET-MORE, and we'll get you in contact with JJ and his team. Get you out house hunting. We'll make you a homeowner this year.
Okay, man, I don't know how often this happens in your life where you think in your head, don't worry, this isn't that bad. I can handle this. And then you get started and you're like, oh, man, I really messed this up. That is something that Matthew was kind of feeling because he needed to sell his house. And so he went and talked to one of his friends who was a realtor and was like, hey, buddy's got this. It's going to be perfect. Until his buddy was like, your house is this situation. Can't do it. Never going to happen. You're stuck with your house. Yes, but Johnny Jennings and the Tom Daves real estate team were able to figure out whatever the complication was and not only sell his house for full price, but to sell it in record time.
Wow, there you go. Hey, here's the bottom line. Johnny Jennings and the Tom Daves team, they sell homes 20% faster than everyone else, and they've got a program where they guarantee to sell your home or they'll buy it themselves. In fact, you can even get an all-cash offer. Just Google Made for More Realty today and get more for your home.